Hello, everyone. This is a quick talk on finance for technologists or techies. To give you an introduction on how C-suite thinks, I'm going to try to do this in 15-20 minutes. So it's a short summary. And if you'd like more, there is a longer form version of the video I'll leave in the description of the video. So without further ado, let's get started. So just projecting my screen here. Yeah, so if you look at Satya and Amy, our CEO and CFO, the two big jobs they have are one is to be efficient, and the number two is to grow, right? So in other words, efficient growth or profitable growth is the goal of any enterprise. And underneath, we will learn concepts like capital efficiency, cost of capital, return on capital, and how to do something called capital allocation, right? So we'll do this in a whirlwind tour, and it's all related to a very simple concept of how capital can grow exponentially over time. Okay, and how to really make business decisions that affect that. Okay, so that's the goal. You want to compound shareholder capital over a long period of time and reinvest and grow. This is very similar to if you put your money in a bank and how it might accrue interest, and then potentially if you reinvest, it'll grow. Similarly, you're putting your money into Microsoft stock, and then it would grow that way. So the first simple idea here, and I promise I won't have too many equations, but the one equation that you should remember is this idea of exponential growth, which is your future capital is your present capital or your principal times an exponent or exponential growth e to the power of gt, where g is the growth rate of your capital and t is the time for which you compound, right? So if you compound for a longer period of time, or if you grow at a faster growth rate, ideally both, that is going to leave you with a larger corpus, right? And Bill Gates said a very prescient thing a long time back. People overestimate what they can do in 1 year and underestimate what you can do in 10 years. So if you take any growth rate, for example, like 26%, hey, 1 year later, you will have $1 will grow to $1.26, right? But do you know that if you allow it to grow for 10 years, it will grow 10x. And if you allow it to grow for 30 years, that will become 30, it'll become 1,000 times, right? So it's not 1 to 1.26, but it's really that 1 to 1,000 which you want to get to, right? That magic of compounding is done by essentially higher growth rate and a longer time team. So the purpose of an engine of growth, such as Microsoft or any other business, is to deliver a risk-adjusted growth rate and do this over and over again. Okay, so keep that in mind, because that's going to be the fundamental of what the key roles are. And as you can see here, I have decomposed this into three parts. One is T, which is the holding period or long term. And the second is compounding, which is related to a concept called reinvesting or capital allocation. And the third is a growth rate, which is ultimately related to capital efficiency or return on capital. Okay, so if you come back to Satya and Amy's primary job, you can think of this red dotted box that I put here as, the Microsoft business or the engine, where you take capital in, okay, put it into assets, convert that to sales, and sales goes to income, and that income or cash flows, you have to reallocate it. Some part you can pay out as dividends or buybacks, and then you can reallocate it back into the capital for growing the business, right? So if you notice, there are two parts of it. One is the efficiency part, where you take capital in and you get income out, and that's called, and a measure of that is called the return on invested capital. You put some capital in, you invested some capital in, that's in the denominator, and what is the income that you got out, and this ratio is called the return, which is very similar to an interest rate if you put your money in a certificate of deposit or a fixed deposit in India, for instance. So you can compare one asset versus the other in terms of, hey, what is that efficiency or what is that return that asset gives you? So return is really a measure of efficiency. And one interesting idea is that return is also the limit on the growth rate. right? Or the organic growth rate is limited by the return. The reason for that is that if you look at the circle that if you look at the cycle that I've shown here, if you put all the money back that you've earned, all the income that you've got or cash flows back and plow it back into the business, you can then compound. You had a $1 in, you get 1 times return on capital, 1 plus return on capital times the input capital, and then you plow it back again and again, and this sort of exponents grows exponentially. And the limit of that is something which is shown here in this equation. It is P times e to the power of ROCT. If you notice that G has been replaced by ROC, in other words, growth and efficiency are actually two sides of the same coin. If you want to grow, you've got to be efficient. So that's why executives manage the company for efficiency. But the second thing the executives have to do is something called capital allocation, which is to take the capital that comes out, the extra capital, and then plow it back into and reinvest it. So you could give part of it back to shareholders and reinvest the rest. So the net of it is that if you reinvest 100%, you can grow at a maximum rate. If you're not able to find enough opportunities for reinvestment, then you can give back the excess capital. So this is a quick summary of the overall topic that we're going to cover, and let's unpack that a bit as we go forward. So the first step is that if you take an investor's viewpoint, where you have savings and you want to invest, you can invest it in either risk-free assets like the US Treasuries and go to Uncle Sam and give your capital there, or you can come and give it to Satya and Amy here. So the Satya and Amy are called agents, and the person who's giving the capital, savers, are called the principals. So there's a differentiation between the principal and agent. And we, as employees of Microsoft, are also agents of the principals who are giving us the capital. And the ultimate measure of our, how we take capital and produce operating income is called the return on invested capital. And that's a measure of efficiency. Now, in addition to this, you can't just infinitely come up with a very, very high return on capital. There is, as you go to higher and higher returns on capital, these investments become risky. So you got to sort of adjust for that risk or subtract for that risk. So one way you do this in business is to say, hey, this is the return and this is the risk, right? If I look at the real rate of return that Satya and Amy are delivering, you got to take the return on capital and then subtract out the risk and then put that subtracted value into the exponent, right? So that is an example of an economic or a real rate of return that Satya and Amy are delivering over and above the alternatives that an investors can have, right? So the general idea is that you can't just compare Microsoft to the US government. The US government is considered to be a risk-free asset. So you've got to add a risk or a risk premium to an entity like Microsoft or Tesla or whoever you want to value here. So the idea is that there's a price of risk that is captured as a sum of the risk-free rate and a risk premium. We'll not go into the details of how the risk premium is calculated, but it's an empirical way called the capital asset pricing model, and you get that. Okay, so net, I think the important thing to recall is return on capital is how you take capital and get to profits. But it's also important that sometimes people confuse it with profitability, which is how revenues convert to profits. Whereas return on capital, there's one more additional step. You take capital or assets, convert it to revenue, and then convert revenue to profits. So return on capital is more than profitability. It's not just profitability. Okay. So the idea of risk and return are captured as these two exponential curves, right? One exponential curve goes up and the other exponential curve goes down. Okay, so this curve that goes up is called compounding, and the curve that comes down is called discounting. That's why we have the idea of the future cash flows in the future. They are discounted because of various forms of risk. They are discounted because of inflation and things like that, and so on, right? So what you can do is you can put these two together. You can think of the first one as e to the power of gt, and the second was e to the power of minus rt, where r stands for risk. Put that together, you can have g minus r in the exponent, right? So the consistent compounding of risk-adjusted returns is what we are trying to get to, right? So that's the goal of what we're trying to get to. So you can look at a business as a two-sided. This is a face of Janus, the Roman god, who has to handle risk on one side and return on the other side. If your return is greater than your cost of capital, you're actually creating economic value. Okay, and then that's great. thumbs up, you got to grow. Okay, so that now you have the license to grow because you're efficient enough to grow. If your return on capital is less than the cost of capital, you're actually destroying economic value. It is not that the return on capital is greater than zero. The return on capital has a higher bar. It has to be greater than something called a hurdle rate, which is the cost of capital. So it is not good enough just because you're earning a non-zero return. You have to earn greater than what the government can pay you, plus a risk premium, right? Which is empirically calculated. So that's the basic idea. So if you're efficient, grow. If you're not efficient, fix your returns before you grow, right? Fix your engine to be lean and mean before you grow. And if you do that, then you can have an exponential function. And if you can notice this formula that I put out here, that shows the real rate of capital accumulation. If you look at the nominal accumulation, that is just return on capital times T on the exponent. So if I come back to a company and how it does its jobs, you take capital from shareholders and bondholders or debt holders, and then put that into assets. That's step one. And then you take those assets and then convert those assets to sales. And those assets can be two types of assets. One is called a working capital type assets. The other is called the fixed assets, like factories and so on. Working capital is things like inventories or payables and receivables and so on, which is which sort of nets out fairly quickly within a year, whereas the fixed capital gives you returns over a longer period of time. Right. And but all this capital also depreciates if you don't use it properly. You have to leverage it and get to sales. And once you have sales, you have to convert or sales or revenue and then convert that to income. And then once you have income, you have the opportunity to reallocate it partly to the capital, incremental capital that you need working and fixed. And then partly you have to reallocate it for growth and you can give it back to shareholders. So this is the essence of how things work. So if you can look at the step one, the step one is also called an asset formation step, where you take capital or liabilities from the debt and equity side, put it on the right-hand side of your balance sheet, as shown in the lower figure here. And then on the left-hand side, you're creating assets. Okay, some are long-lived assets are called fixed assets, and then the others are called short-term assets, working capital assets. Now you should be very careful that working capital, even though it is short-term, it could still dominate your balance sheet. In some businesses like Walmart and others, sometimes the fixed assets might look more salient. You can look at a huge Walmart's big box store, but their working capital can be much higher than their fixed assets if not managed properly, right? So in other cases, the fixed assets could dominate the overall balance sheet. So this whole thing is called a balance sheet, which sort of shows how healthy the company is from a point of view of the left and the right side, and how much cash do you have, and then how much flexibility do you have, right? The next step is to convert this capital to sales, and that usually is a key part of a business model. So many interesting business models are: how do I take my fixed capital, convert it to sales? How do I take my working capital and convert it to sales? And the reason you put your money into capital is that if you do not have capital, let's say you're churning out lemon juice and so on, if you just have to take lemon and then sort of squish it with your hand and create lemon juice and put it and so on, right? Rather than if you have a juicer that quickly gets you that juice, you're becoming far more efficient, right? So in other words, you're able to churn out many more lemon juice cycles out of that, right? So that efficiency of how do you actually take your capital and quickly get to sales or revenue, that's called the sales to capital efficiency. And this holds both for working capital as well as fixed capital. So a lot of interesting business models involve designing this and paying attention to the conversion of capital to sales. Okay. And the next step, once you have sales, is hey, what is my COGS, or what is my various forms of costs? One is the costs that are directly involved, that is called cost of goods sold, and then what are my operating costs of my other employees and so on, to get operating profits. And then you can ultimately net out other investments into incremental capital, such as depreciation, interest, etc., and then get your final final net margins out of that. So, or net profits. So this division of the profits to revenue, that's a measure of the efficiency in which you convert your revenue to profits, and that's called profitability, right? So, and this is captured in the income statement or the P&L statement, which is the second statement. And cash flows are slightly different from profits because it's, you may have booked some revenues and profits, but you may not actually have the cash attached to that. So if you follow the money or follow the cash, then you can see how your cash put into capital gets converted to cash revenue, and then how that cash revenue gets converted to cash profits. And then, hey, how do I actually add some extra working capital? And then if I subtract that out, that's called cash flow from operations, CFOA. And then if I subtract out the investments in fixed capital, I get free cash flow. And then if I take out the interest payments and other financing costs, I get free cash flow to equity, right? So these are the key terms that come out, and there are some variants such as EBITDA, which is earnings before interest and taxes. It's a measure of operating income. Is one of the things. Normally, operating income refers to profit after taxes, but here you can look at, hey, what is my earnings before taxes, interest and taxes, and then you can also subtract out depreciation and amortization. You use that to analyze companies which have a fairly large asset base to really look at the operating efficiency of these companies. And finally, you close the loop. So once you've gotten income, how do I close the loop back and do reinvestment? Remember that this closing of the loop is very, very important. People underestimate this, and this is a key step called capital allocation. There are companies in the world that have an excellent engine that gives you a very high return on capital, but they do not reinvest, or they do not have enough opportunities to reinvest their capital. And I shall give you some examples, and that actually limits how the valuation can be in the marketplace, right? So, end of the day, if you're able to be an efficient engine, and if you're able to reinvest and actually do the cycle of efficiency over and over again, you get all the key pieces. That efficiency becomes the G in that e to the power of GT, and it's bounded by return on capital. And the T is for the long term in which you do this. And then e to the power of really comes from the reinvestment step. That compounding or the e to the power of step comes only when you reinvest. So if you do not have reinvestment, you will not compound, right? And the other interesting thing is that if you're not efficient, and what will happen is you will be demanding more and more capital to grow. If you try to grow without being efficient, you will actually consume or burn more capital, right? So the important thing is once get to an efficiency engine and then scale. Typically, there is sort of this, sometimes it's a rush to growth. Hey, I want to quickly grow at any cost and so on. That's actually, you have to be careful about that. Just there are some situations you may want to do that to capture market share or have network effects. But most of the situations, it's better for you to actually iron out the engine before you grow. So to summarize this, if you look at businesses, you're dealing with customers, you have to give them value, and that's called a customer value proposition. And you have a product market fit with which you give the value. You have a product in the customer market, you meet them, and then you are able to engage them repeatedly. The customer uses it or buys it or makes a places an order. And that's called monetization of that customer's intent. And then from that order, you get to revenue. That's a conversion of orders to revenue. And then ultimately, then you subtract out all the costs. You can also think of these costs as actually investments. You have a COGS investment, you have an SG&A investment, sales, general, and administrative cost investment. And then you have an investment into additional working capital, where you get from operating profit to get to cash flow from operations. And then you subtract out additional investment in your CapEx, then you get to free cash flow to firm, and then you subtract out the debt or interest to get free cash flow to equity. Because it's this free cash flow to equity, which is ultimately that something that can pay your dividends or buybacks and things like that, or it can be further reinvested back. So this is the summary of customer value to free cash flows. Sorry. So ultimately, wherever you're in the journey of your business, you have to see how you are able to do this, and you want to do this efficiently, and you want to do this over and over again. Okay. Finally, I'll leave you with valuation versus this efficiency cycle that I talked about. If you have an engine that can give you high return on capital or low return on capital, and you compare it to the market, risk adjusted, basically cost of capital attached to you. If your return on capital is less than your cost of capital, this is sometimes measured by something called WACC, weighted average cost of capital. You should stop growing. You should actually fix your engine to get to good return on capital before you grow. But if you have high return on capital, you actually have to grow. If you look at this picture here, you have an entity that can get a very high price to earnings ratio. If it can grow, and that is on this y-axis, you have earnings growth here to 10%, and you have a return on capital of 24%, you get a high return on capital multiple. In fact, if you can grow even faster, even better, right? Up to 25%, right? The second is that if you have a high return on capital but do not grow, you get a medium price to earning multiple here. If you have a low return on capital and if you try to grow faster, in fact, you get even lower valuation, right, in the marketplace. And this can be also measured in other sorts of values like price to book ratios and so on. So the market is giving us a very clear signal. If you're efficient, then grow. If you don't grow, I will actually give you less value. If you're not efficient, then stop growing and fix your efficiency engine, right? So that's the basic idea. And then if you grow, then that becomes an exponential phenomena that will ultimately allow you to compound your capital. So if you put it all together and ask, hey, how good a job are Satya and Amy doing for us for Microsoft? This is a picture I picked up from a place called roic.ai, and you can look it up for Microsoft. So if you can look here, the market is actually valuing us at a premium to the S&P 500, 1.39 here, and there's a price to earning ratio here. But if you notice, the Satya and Amy are actually delivering a high return on equity and a high return on invested capital. And this is shown in the green bar here, and this is over several years. If you can look at the numbers here, you are getting excellent return on capital over year in and year out, and that's one of the reasons why Wall Street loves Microsoft. The second is that if you look at the part which is profitability, Microsoft is really a profit engine, which gives you close to 40% operating profit margin. This is really outstanding operating margin and 70% gross margin, amazing gross margins and net profit margins of 33%, right? You can even adjust this for capitalize some of the employee costs because they're R&D and so on. But despite that, right, it's amazing profit margins compared to the rest of the S&P. And finally, the free cash flow to growth, if you look at the growth picture, free cash flow per share is also growing at about 18% over the last few years, right? So you can see that your return on capital is 24, but my growth rate is 18, right? So the interesting thing that Satya and Amy can do is if I can maintain the return on capital, I have the license to grow even faster. So the opportunity for Microsoft is to grow up to 25%, right? Growth rate. So that's why the engines like cloud and so on are amazing, and OpenAI investments are amazing because they can drive further growth if they can maintain the return on capital. So quick summary, ultimately the exponential growth of capital e to the power of GT is the key thing that we want to get, the dynamic. That's why savers are investing in Microsoft. That G is bounded by return on capital, ROC. And T is the time for which you want to do this. You want to do this over and over again. We executives, the C-suite manages the company for the long term. And G is bounded by return on capital. Which is nothing but a measure of efficiency for each turn of the crank. And then you got to keep cranking this over and over again. And that process called capital allocation. Got to be mindful of risk. If your return on capital is less than risk, you're actually destroying economic value. So you should stop destroying it further and then fix your engine first. If you're doing well, then you can actually grow. And typically, executives have to balance these two things simultaneously. Okay, in the long form of the talk, I do cover other aspects like industry cross-structure, goal of strategy, and so on. If you're interested, please feel free to look into that. With that, I will stop the recording here. And I will thank you for your time.